Welcome back to Power Lunch. The S&P hitting another new record today as key inflation and earnings data from major financial and consumer companies are on this week's agenda. Our next guest doesn't think the Fed's 2% inflation goal will be met without an extended period of subpar economic growth. But are we there yet? Let's ask Rich Bernstein, CEO and Chief Investment Officer of Richard Bernstein. I'm always trying to pin you down, Rich. I appreciate you being here. Is he bullish? Is he bearish? And I thought it was interesting that Piper dropped coverage of the S&P 500, and I thought, is everyone just getting frustrated with this market? Are you amongst them? Like, does it stack up against historical experience, or are we experiencing something very different?
So, Kelly, I saw stats today that showed that year to date through July 5th, that only 21% of the companies in the S&P 500 have actually outperformed the index so far this year. That is now narrower. If this were the end of the year, it would be narrower than during the tech bubble. So You can understand why people are getting so frustrated. I've used the seesaw analogy with you many times, that the seesaw is bent in a rather precarious position, and the opportunities have to be on the other side of the seesaw. Like, who doesn't know about the 7 stocks? But, people's knowledge of the other 493 is probably woefully inadequate.
Why do the opportunities have to be on the other end of the seesaw? Why don't I want to invest in the secular, miraculous innovation? Why wouldn't I rather stick with what's working, what has 30% earnings growth, than go to what has 5%?
Well, Kelly, by the end of the year, the Magnificent Seven earnings growth is supposed to be, according to analyst forecasts, is supposed to be lower than what you're going to get in the slower than what you're going to get in the Russell 2000, and slower earnings growth than what you're going to get in emerging markets. So I think this notion that, and there's about 160 companies growing earnings just in the S&P, growing earnings 25% or more. So I think people are really overlooking opportunities. It's not that the Magnificent Seven are bad companies or anything like that, but are they unique? And the answer to that is clearly no, they are not unique. They do not deserve the amount of attention, the valuations they're getting, and everything else relative to the growth that you can get in other areas of the global equity market that are similar, if not better, with much cheaper valuations.
So you're arguing strongly there for smaller companies and for international companies, emerging market companies. But I want to turn, correct me if I'm wrong on that, but I want to turn to something that stood out to me, and that is your assertion that we're entering, as an economy, the United States is entering a time when, A, deglobalization is the governing trend, not globalization, and second, that the U.S. is going to be forced to regain its economic independence because of, in part, that deglobalization and tensions, trade tensions around the world. Explain to me what the investment implications of those two things are, what kinds of stocks I'm going to want to look at.
Sure. So there's two things that I think investors should take away from that. Number one is that we would argue at my firm, Richard Bernstein Advisors, we would argue that the number one reason, not the sole reason, but the number one reason that we had secular disinflation was globalization. That what globalization did was it consistently increased competition. And everybody knows that when you increase competition, you get downward pressure on prices. That's now called secular disinflation. As we change from globalization to deglobalization, our mindset should start changing from secular disinflation to secular inflation. That doesn't mean 8% inflation, but instead of a forecast of 2 to 2.5, probably 3 to 3.5 or maybe 4% inflation is a realistic number. Second thing is that globalization did exactly what your textbook said it should do, Tyler. It sent production to where it was. It sent production to where it was most efficient, where it was most productive. Unfortunately, that was not in the United States. So the end result is the United States runs a massive trade deficit, which was no big deal as long as globalization was expanding. But when globalization contracts and you run a massive trade deficit, look, here's the way to think about it. Why does everybody understand the national security implications of being dependent on the rest of the world for semiconductors, but we don't understand the risks being dependent on the rest of the world for everything? We are dependent on the rest of the world. So we think the capital markets are going to be smart enough to understand this risk and to reallocate capital to where it's needed. Where is that? I would say the number one sector is the industrial sector, followed by energy and materials.